Welcome to Griffonomics.
It is great to be back.
Yeah, so usually when we sit down to do one of these deep dives, especially when the topic is, land in Texas, I feel like I know exactly where the conversation is going.
Oh, really? Where is that?
Well, you know where. Oil, black gold, Texas tea. It's the classic Beverly Hillbillies narrative, right? We talk about drilling rigs, we talk about the price of a barrel of crude, and we talk about extraction.
Right.
Because value, historically speaking, comes from what you pull out of the ground.
And that has been the narrative for the Permian Basin for, well, about a century. And for very good reason.
Yeah.
I mean, it's the most productive oil patch in the Western Hemisphere.
Right. But today you sent over a stack of research that, it kind of flips that entire narrative on its head. Because we aren't really talking about oil today, are we?
No, we aren't. We are conducting an investigation into something we are calling the surface economy.
The surface economy. I mean, it sounds a bit drier than gushers and wildcatters.
It might sound drier, but the margins are significantly better.
Yeah.
We are looking at a company called LandBridge, ticker symbol LB. And if those of you listening think this is just another passive landowner waiting for a royalty check to show up in the mail, you are missing the forest for the trees. Or I guess, given where this land is, you are missing the scrub brush for the cactus.
Fair enough. But help me set the stage here. Because when I look at LandBridge on paper, they own a massive amount of dirt in the Permian Basin. How is this not fundamentally an oil story?
Because LandBridge is undergoing a complete metamorphosis. They are transforming from a passive landlord, which is the old model, into an active package solution provider for the two hottest, most capital-intensive sectors in the global market right now.
Let me guess. One of them is artificial intelligence.
AI and data centers, yes.
Yeah.
And the other is energy, but specifically the logistics and water side of energy. We are witnessing an inflection point where dirt, literal acreage, stops being just a wrapper for the oil underneath and becomes the critical substrate for the digital age.
That is a huge claim. Substrate for the digital age. That sounds like a Silicon Valley pitch, not a Texas real estate pitch.
It is a bit of both. Our mission for this deep dive is to generate a granular investigative report on this exact shift. We need to understand how LandBridge is moving from simply collecting rent to actively architecting industrial hubs.
And to do that, we have a ton of ground to cover.
Literally and figuratively. We have to unpack three very specific, very dense topics.
Write them out for us.
First, we need to understand their triple stack revenue model. Second, we have to look at the operational synergy with their sister company, WaterBridge. And third, and this is the one that is going to melt your brain a little bit, we need to look at the massive behind-the-meter data center migration that is happening right now in West Texas.
Okay, behind the meter is a phrase I definitely want to dig into later because I keep hearing it, and I am not entirely sure everyone listening knows what it means in this context.
We will get there.
But let's start with the basics.
Yeah.
Section 1, the business model transformation. They call it active land management.
Right.
Now, stop me if I'm wrong, but active land management sounds a lot like corporate speak for we raise the rent.
A little bit more complex than that. To appreciate the active model, you really have to understand the passive model first. The old way of doing business in land management, think about the legacy ranch families in Texas, was pretty sleepy.
The mailbox money lifestyle.
Exactly. You own the land. An oil company like Chevron or Exxon came along and leased it from you. They did all the heavy lifting. They brought the rigs. They drilled the holes.
And you just sat back.
You sat on your porch and waited.
Yeah.
If they struck oil, you got a check. If they didn't, you waited some more. You were a passenger in your own car.
I mean, it is not a bad gig if you can get it.
It's great work if you can get it, but it leaves so much value on the table. LandBridge is saying, no, we aren't passengers. We are driving the car. Active land management means maximizing commercial activity on every single acre. It is entirely about density.
Density in the desert.
Economic density. Instead of having one revenue stream, say an oil well on a plot of land, they want overlapping streams on that exact same plot. They want a pipeline easement. They want a road fee. They want a water disposal royalty. They want a sand mine. And maybe a solar farm or a data center on top of it all.
So it's like, okay, imagine a parking lot. The old model is just charging a flat fee for parking. The new model is you own the parking, but you also own the toll booth to get in. You own the vending machines, you own the gas station in the corner, and you are generating and selling the electricity that lights the place up.
That is a surprisingly accurate analogy. It is about stacking revenue. And when you look at their revenue breakdown, the success of this strategy is just staring you in the face. They call it the fee and logistics engine.
Let's break that down because the numbers here were the first thing in the research that really made me pause. You would expect an oil-adjacent company to be heavily dependent on oil revenue.
But they aren't. That is the twist. Look at the data from 2025. Surface use accounts for 68% of their revenue.
68%. Okay, but define surface use for us. Is that just grazing fees for cattle?
No, and this is where people get confused. Surface use is a catch-all term for the toll road of energy development. It includes fees for easements. So if a company wants to run a pipeline across LandBridge property, they pay a fee per foot. If they want to build a road, they pay. But crucially, the biggest chunk of this is produced water royalties.
We're going to spend a lot of time on water later, I know. But basically, they get paid when dirty water goes back into their ground.
Correct. It is a disposal fee. And you have the second bucket, resource sales. That is about 24% of revenue.
And this is literally selling the earth itself.
Literally selling physical earth. They sell brackish water.
Brackish.
Non-potable, salty groundwater. You cannot drink it. You cannot water crops with it. But oil companies need millions of gallons of it for fracking fluid. So LandBridge pumps it up and sells it to Chevron and ExxonMobil.
Talk about turning lemons into lemonade or salt water into money.
They also sell sand and caliche.
Caliche.
It is a sedimentary rock found all over West Texas. It is used to build the roads and the physical pads for the drilling rigs. So if you are an oil company, you need water, you need sand, you need rock to drill a well. LandBridge says, why truck it in from 100 miles away? We have it right here.
So that is 92% of their revenue coming from the surface, or just barely below it.
Which leaves only 6% coming from oil and gas royalties.
That is a tiny slice of the pie for a company operating in the Permian. I mean, usually these land companies live and die by the price of oil.
And that is a feature, not a bug. This is what you really need to understand if you are looking at this from an investment perspective. It insulates them. If oil prices crash tomorrow, LandBridge is significantly protected because they aren't relying on the price of the commodity. They are relying on the volume of activity. They are the landlord, not the speculator.
But hold on a second. If oil prices crash, doesn't the volume of activity go down anyway? Like, don't the drills stop spinning?
Eventually, yes, new drilling slows down. But because LandBridge provides the essential ingredients, the water, the sand, the disposal, even if new drilling stops, the existing wells still produce water that needs to be disposed of every single day.
Yeah.
The recurring revenue from that disposal is much stickier than the volatile price of a barrel of crude.
Okay, that makes sense. Now, they have created a specific metric to track this non-oil revenue, right? The SUE.
Yes. SUE, Surface Use Economic Efficiency.
I have to be honest, whenever a company invents their own acronym, my BS detector instantly goes off. Is this just a creative way to hide bad performance in other areas?
I share that skepticism, usually.
Yeah.
I really do. But in this case, the SUVE is actually quite helpful because it explicitly excludes those volatile oil and gas royalties. It forces you to look at how well they are monetizing the dirt itself. It measures revenue generated per acre strictly from surface activities.
So it is a direct measure of how good of a landlord they are.
Exactly. And the growth there is wild. If you look at their legacy acreage back in 2021, they were generating under $465 per acre. By 2025, that number hit $11,059 per acre.
So they more than doubled the yield of the land just by being smarter about fees and resources.
Right. Total portfolio SUE grew 21% year over year to $658 per acre. But here's the kicker. Management has a North Star target. They believe the long-term potential isn't $1,000. They are actively aiming for $2,500 to $3,500 per acre.
Wait, hold on. $3,500 an acre, that is triple today's numbers. Is that actually realistic, or is this just a pitch deck dream to pump the stock?
It sounds aggressive, doesn't it? But that valuation isn't based on selling more sand or charging slightly more for a road. That valuation is based on what we are going to discuss next. The hidden giant. The reason this land is becoming so profoundly valuable isn't just what is on the surface, but the empty space underneath it.
Which brings us to section 2, water and pore space.
This is the part that isn't sexy to the average person. But to anyone analyzing the business, this should be the most exciting part of our deep dive. This is the operational moat.
We mentioned WaterBridge earlier. This is the sister company.
Right. It is important to understand the corporate structure here. WaterBridge and LandBridge are two sides of the same coin. WaterBridge handles the pipes, the pumps, the disposal facilities. They are the hardware. They are the plumbing. LandBridge owns the land and, crucially, the pore space underneath it.
Okay, let's unpack pore space. Because to me, pores are something I buy expensive face wash for. What does it mean in geology?
In geology, pore space is simply the empty voids in the rock formation underground. Think of it as a massive subterranean sponge. It is storage capacity.
And why is this sponge so valuable? Why would anyone pay for empty holes in a rock?
Because of the physics of fracking. In the Permian Basin, for every 1 barrel of oil you pull out of the ground, you're also pulling out anywhere from 4 to 10 barrels of produced water.
18 barrels, so it is mostly water coming out of an oil well.
It is mostly water. And this isn't Evian. This isn't something you can bottle and sell at a grocery store.
Yeah.
It is dirty, salty, toxic wastewater mixed with drilling chemicals. You cannot dump it in a river. You cannot spray it on crops. It is hazardous material.
Okay, so what do you do with it?
It has to go somewhere. The only economic solution, the only way the entire oil industry survives out there is to inject it back deep underground into that pore space.
So if you don't have pore space, you can't get rid of the water. And if you can't get rid of the water, you physically cannot produce the oil.
Exactly. The pore space is the ultimate bottleneck. The Texas Railroad Commission is very strict about this. And here is where the story gets dramatic. In other parts of the Permian, specifically the state line area near New Mexico, they have a full-blown crisis.
What kind of crisis?
They have injected so much water over the last decade that they have overpressurized the formations.
Like blowing up a balloon until it is just about to pop.
Essentially, yes. And you know what happens when you overpressurize deep rock formations?
I am guessing it is not good.
You get induced seismicity, earthquakes.
Earthquakes in Texas.
Real measurable earthquakes. And because of that, regulators have stepped in and capped injection in those specific areas. They're saying no more. They are shutting down the disposal wells.
So the drillers in those areas are in serious trouble. They have all this water coming up and literally nowhere to put it.
They are desperate. But LandBridge, they own prime low-pressure pore space. They aren't overpressurized. They have over 2 million barrels per day of permitted disposal capacity.
So they have the empty balloon when everyone else's is completely full.
And that creates what they call flow assurance.
Yeah.
Because LandBridge and WaterBridge control this disposal capacity. They go to a driller like Chevron or ConocoPhillips and guarantee that their water will be handled. That certainty is worth a massive premium in this market.
It's a moat.
It is an impenetrable moat. It creates a blocking position. LandBridge has acquired contiguous, land-large, unbroken blocks of it. If a competitor wants to move water from New Mexico, where the earthquakes are, into Texas, where the disposal capacity is, they likely have to cross LandBridge land.
So they have to pay a toll.
Or they have to use LandBridge pore space and pay a royalty. Either way, LandBridge gets paid. This segment is the steady, boring anchor that generated the lion's share of their $177.2 million EBITDA. It is the defensive play that protects the downside.
Okay, so that is the defense. The water business keeps the lights on and pays the dividends. But now let's talk about the offense. The reason people are whispering about this stock potentially being a massive multi-bagger. Section 3, the data center thesis.
This is the call option on AI.
We all know the macro story by now. AI needs chips, chips need power, but there is a huge problem.
The grid is broken. That is the simple version. The hyperscalers, Google, Microsoft, Amazon, Meta, are sitting on billions of dollars of high-end NVIDIA chips. They're ready to deploy them, but they literally have nowhere to plug them in.
I read in the sources that in Virginia, which is known as Data Center Alley, the wait time for grid power is something like 6 years.
6 years. It is absurd. And in New York, they have outright moratoriums. The utility grid simply cannot keep up with the demand. It takes years to permit and build high-voltage transmission lines. But tech companies operate on tech timelines, not utility timelines. They cannot wait 6 years to deploy capital. They need power now.
So they are actively looking for a backdoor.
They are looking for behind-the-meter power.
You mentioned this phrase earlier. Explain behind the meter for us so everyone is on the same page.
Normally, a data center connects to the public electrical grid. That is in front of the meter. You rely on the utility company to send you electrons. Behind the meter means you build a power plant directly on the data center site. You generate your own electricity and consume it right there. You bypass the public utility grid entirely.
You go off-grid.
Essentially, yes. And this is where the West Texas advantage comes in. LandBridge made a very specific acquisition recently called the Wolfbone Ranch.
Wolfbone Ranch. It sounds like a setting for a Western movie.
It really does. But strategically, it sits right on top of the Waha gas hub.
And for those of you listening who don't casually follow natural gas markets, which I assume is most of us, why is Waha so important?
Because Waha is where the glut of natural gas lives. There is so much natural gas produced as a byproduct of oil drilling in the Permian that they literally cannot get it all out of the region. It is trapped gas. The supply vastly exceeds the pipeline takeaway capacity.
I have heard stories of prices going negative down there.
It happens frequently. Producers will literally pay you to take the gas away so they don't have to stop drilling for the much more lucrative oil. So think about the economics here. If you are Amazon building a data center in Virginia, your industrial power from the grid might cost 8 to 12 cents per kilowatt hour.
Okay.
In West Texas, utilizing this trapped gas behind the meter, you can generate your own power for 2 to 3 cents per kilowatt hour.
That is a massive delta. You are cutting the single biggest operating cost of a data center by like 75%.
Exactly. And LandBridge owns the land, and they have the access to that cheap gas. But they aren't just going to rent the land for a flat fee. This is where the active land management philosophy comes back in. They have developed a triple-stack revenue model specifically for data centers.
Walk us through the triple stack, because usually a commercial landlord just gets rent.
Right. Layer 1 is the ground lease. This is your standard rent. They are looking at around $4,000 per acre annually.
Okay, that is nice. But $4,000 an acre isn't going to get you to a multi-billion-dollar valuation.
No, it is not. That is just the appetizer. Layer 2 is water sales. Data centers generate immense heat. They need massive amounts of cooling. We are talking 150,000 to 350,000 barrels of water per day for a large campus.
And since they are in the desert?
LandBridge has the brackish water beneath the surface, and they sell it to the data center. That is a recurring, high-margin revenue stream.
And layer 3?
The power spread. This is the absolute kicker. LandBridge intends to take a participation cut, say 5% of the spread, between the cost to generate the power, which is that cheap 2 cents, and the price it is sold to the data center.
So they get a piece of the energy arbitrage. They are effectively becoming a mini utility company.
Correct. When you run the numbers, what analysts are calling the 1 GW math for a single gigawatt campus, it gets staggering.
Give us the numbers.
We are looking at estimated annual revenue of $35 million to $87 million per channel.
Campus. And how many campuses can they fit on their land?
Management says they have 6 distinct sites identified as campus ready right now.
So let's do the math. 35 to 87 million per site, 6 sites. If they land just one definitive deal, it fundamentally changes the entire financial profile of the company.
It re-rates the stock immediately. But I do have to play the role of the careful analyst here for a moment.
Please do, because this frankly sounds almost too good.
As of right now, there is no named hyperscaler deal announced. There is no press release saying Google or Meta is building on LandBridge land. That is the catalyst everyone in the market is waiting for. It is the speculation component.
So is this all just vaporware? A nice slide deck dream?
No, they have a proof of concept. They actually signed a multi-decade lease for 2,000 acres at that $4,000 per acre price point, and it included the power spread participation. So they have executed a deal. We just don't know who the counterparty is yet, or if it's one of the Magnificent Seven. But it proves the model works legally and commercially. Now they just need the big fish.
Okay, so that is the dream. Let's look at the reality today. Section 4, Financial Realities and the FY 2025 Review. How is the base business actually performing while they wait for this AI boom?
The scoreboard is objectively impressive. They reported record momentum. Revenue came in at $199.1 million, which was up 81% year over year. Adjusted EBITDA was $177.2 million, up 83%.
Wait, hold on. Let me process that. $199 million in revenue and $177 million in EBITDA.
I know. The math looks wrong at first glance, doesn't it?
That is almost all of it dropping to the bottom line. How do you have expenses that low?
It is an 89% EBITDA margin.
89% sounds fake.
Yeah.
Seriously, how do you hide the operating costs? Is this sustainable, or is it some kind of accounting magic?
It feels like magic, but it is entirely structural. It is the power of a pure asset-light model. Think about it. They don't drill the wells. They don't lay the heavy pipes. WaterBridge does that. They don't staff the drilling rigs. They just own the dirt.
So their costs are what exactly? Property taxes and a few lawyers.
Essentially, yes. A lean management team, some legal fees, administrative overhead, some tax. That is really it. Their free cash flow margin is 61%. This is what we call a 10 out of 10 margin profile. It is a cash printing machine.
It is deeply impressive. So what are they doing with all this cash? Are they just hoarding it on the balance sheet?
A mix of things regarding capital allocation. They increased the dividend by 20%, which income-focused investors will obviously love. They authorized a $50 million share repurchase program. But we also have to look at the leverage. Net leverage ticked up slightly to 2.8 times.
That is a bit higher than their stated target, isn't it?
It is. Their target range is 2.0 to 2.5 times. The increase came because they were aggressive. They went shopping.
Shopping for what? More land.
Exactly. Which leads us perfectly to Section 5, Strategic Expansion and the 2026 Roadmap, and specifically the purchase of the 1918 ranch.
The 1918 ranch. This is the big acquisition that caused that leverage bump.
It is, and we need to spend some time here because the broader market hasn't fully digested what this means yet. They purchased 3,700 acres.
That is the size of a small city.
It is massive. But in real estate, it is always about location, location, location. The 1918 ranch sits squarely in the path of development. But the strategic value isn't just the surface acreage. It added approximately 900,000 barrels per day of pore space capacity.
That is nearly a 50% increase in their total capacity just from one single deal.
Exactly. And remember that blocking position we talked about earlier?
The monopoly toll road.
The 1918 ranch completely consolidates that position. It is contiguous with their existing land. It effectively builds a physical wall between the earthquake-prone New Mexico border and the safe disposal zones in Texas. If you want to move water from west to east, you basically have to deal with LandBridge now.
So they essentially bought a monopoly on the route.
In many ways, yes. But here's the most interesting detail regarding their financial guidance that I think a lot of retail investors missed.
Go on.
Their baseline 2026 guidance calls for $205 million to $225 million in EBITDA. That is solid growth. But management explicitly stated that this guidance entirely excludes the commercialization of the 1918 ranch.
Wait, they bought this massive asset, took on debt for it, but they aren't counting any revenue from it in their forecast.
Correct. And the guidance also excludes any potential data center win.
So they are sandbagging.
Massive sandbagging. This is the definition of asymmetric upside. The guidance is the absolute floor. It is the worst case scenario. If they monetize the ranch, which they actively are doing, or if they sign a hyperscaler, which they are trying to do, the numbers go significantly higher than that $225 million ceiling.
Okay, so the base case is incredibly safe and the upside is basically free. But they aren't just sitting passively on this land waiting. They are doing other deals too to prepare for this shift. What about this Samsung partnership?
Yes, Samsung C&T Renewables, or SCTR, they signed a deal giving Samsung exclusive rights to develop 350 megawatts of battery energy storage systems, BES, in Pecos and Loving counties.
Battery storage. So that plays directly into the grid stability theme.
Exactly. If you are going to have data centers running 247 and solar farms generating intermittent power, you need massive industrial batteries to smooth out the load. LandBridge is partnering with Samsung to build that critical infrastructure.
And what about NRG Energy?
That is another strategic partnership, the potential construction of a 1.1 gigawatt grid-connected natural gas power plant.
A gigawatt plant. That is huge.
It is massive, and it is intended specifically to power future data centers. So when you look at these deals collectively, Samsung, NRG, the upcoming Speedway pipeline, which is targeted for mid-2026 to drive a step change in water royalties, you see a company that is laying the foundation. They aren't just hoping data centers come, they are building the power plant and the battery storage to ensure they come.
It is very Field of Dreams. If you build it, they will come.
But with much better profit margins.
Okay, let's look at the broader landscape. Section 6, competitive landscape and risks. Because surely they aren't the only game in town trying to do this.
No, they aren't. The primary rival, the absolute elephant in the room, is Texas Pacific Land, ticker TPL.
The big brother of the Permian.
The giant. TPL has been around for over a century. They are the benchmark comparison everyone makes. But there are key differences that investors really need to understand before choosing between them. First is valuation. TPL trades at a massive premium, about 28.7 times 2026 EBITDA.
That is steep for a land company.
It is priced for perfection. LandBridge, on the other hand, trades at roughly 19.1 times.
So LandBridge is significantly cheaper. Why the gap?
Part of it is simply track record. TPL has been public forever. LandBridge is much newer to the public markets. But the revenue mix is the real fundamental differentiator. TPL has huge exposure to oil and gas mineral royalties. About 54% of their revenue comes directly from the commodity.
So if oil prices crash, TPL gets hurt.
TPL gets hurt a lot more. LandBridge only has that 6% mineral exposure. As we discussed, LandBridge is volume dependent while TPL is heavily price dependent.
But they're both chasing these massive AI data center deals.
They are. And TPL isn't sleeping on this. They recently partnered with Bolt, which is a company backed by Eric Schmidt.
The former Google CEO.
The very same. So TPL has the connections. They have the pedigree in Silicon Valley. It is a real competitive race.
What about other competitors? I have heard rumors of Fermi America trying to do something similar.
Fermi is an interesting case study. They're trying to execute the triple stack model too. But they have a fatal flaw, in my opinion, that makes them much higher risk.
Which is?
They don't actually own the dirt. They have to go out and buy or lease the land piecemeal. They have to negotiate and secure the water rights from someone else. They have to build the entire plant from scratch. It is incredibly capital intensive. LandBridge already owns the land. They already control the water. They're simply monetizing what they have. Fermi has to build the castle from scratch, whereas LandBridge is just opening the drawbridge to a castle they already own.
That is a massive distinction in risk profile. Management talks a lot about their moat being nearly impossible to replicate.
It is the physical geometry of it. You can buy land, sure, you can build a water pipe. But to buy contiguous land blocks big enough for a 1 gigawatt campus in the most active oil basin in the world, while simultaneously operating the largest private water network on top of prime pore space, that combination is singular. It is exceptionally hard to copy.
So bringing this all together, Section 7, the final verdict. The thesis here looks like a very high conviction re-rating story.
That is the synthesis, yes. You have a surface economy that is very real and generating 89% margins today.
That is the defense we talked about.
Right. You have the water and pore space that provides a defensive floor that likely covers the current valuation all on its own. Even if AI never comes to Texas, even if the data centers decide to just wait it out in Virginia, the water disposal business alone justifies the stock price.
And the assets.
You have the explosive ceiling, the data centers, the AI narrative. It acts as a completely free call option. If it happens, if they sign one single hyperscaler deal, the stock acts like a high-growth tech stock. If it doesn't, it acts like a very high-yield infrastructure stock.
And the thesis for the re-rating is that valuation gap closing between LandBridge and TPL.
Exactly. As soon as the first hyperscaler deal is announced publicly, that gap from 19.1 times to 28.7 times should rapidly shrink. The market will realize that LandBridge isn't just a cheaper TPL, but potentially a much more stable one because of the insulated water mode.
So what is the official rating then?
Strong buy. Asymmetric upside.
Risk defined. Portfolio protected.
Precisely.
So what does this mean for you, the listener? Let's wrap this up with the so. Why should you care about dirt and empty space in West Texas?
Because we are summarizing a generational macroeconomic shift here. We are moving from a world where land value was defined entirely by what you could pull out of it, which was oil, to a world where value is defined by what you can put on it, compute power, and what you can put back into it, water and carbon.
It is a total reimagining of the asset class. It is not just traditional real estate anymore.
It isn't. And here is a final provocative thought for you to chew on as we close. We always hear that phrase, data is the new oil.
It is the ultimate tech cliche at this point.
It is. But if data is the new oil, then the surface economy is the new drilling rig. LandBridge isn't an oil company. It isn't really even a real estate company in the traditional sense. It is the physical landlord for the digital future. They own the very substrate that the cloud relies on to exist.
That is a fascinating way to look at it. You literally cannot have the cloud without the ground.
And they own the ground.
A massive thanks to the team for pulling together the granular research on this one. This has been a deep dive into LandBridge and the surface economy.
Always a pleasure to break it down.
We will see you all on the next one. Risk defined, portfolio protected.